You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Hello and welcome to another week of the Perth Property Show. My name is Trent Fleskins, your host as always. Every week we get Perth's #1 experts in their field into the studio to chat about their relevant industry topic. Today we're talking depreciation reports. Have you got one? What is it? To help us through with this conversation, we've got CBRE's Valuations Managing Director, Mike Veletta. Mike, thanks for coming in.
Thanks, Trent. Good to be here again this morning.
Mike, let's kick it off. Let's start with what is a depreciation report and what is depreciation?
Look, Trent, initially depreciation schedules are most commonly used to lower property investors' tax liability. Investors can typically claim between 2 to 4% of their purchase price in the first full year. So that generally relates to the new product. But depreciation schedules we provide through CBRE is effectively 40 years forecast in terms of the life of a residential investment property.
And depreciation itself, let's strip it back even further. What's going on there? Why are we getting a depreciation report? What's the ideology behind depreciation on a house?
Yeah, look, obviously apart from that, the tax benefits are significant, and the number of people that actually don't utilise those tax benefits to the full are significant. In fact, the majority would not use them and would not understand how they work. Look, depreciation is a deterioration of an asset. In this case, the investment property, and we're talking about residential property, so residential properties, and it's accepted by the ATO as a deduction to offset the tax payable on your assessable income.
Okay, so it's a book tax really. It's not something we're paying an invoice for. It's a understanding that our asset we've invested in is depreciating in value and writing that value down over time at a set rate.
Absolutely. And if you think about the income of a property and you're sort of trying to write things off along the way, depreciation is a classic. It basically contributes to negative gearing in many respects, and it contributes to the tax benefits of owning a residential investment property.
It can be a game changer, can't it? For those people on the borderline of neutral gearing, it can be a situation where on a cash flow level you actually come out neutral or just positive. But when you add in the depreciation report and the benefits of that, you could actually be getting some tax back.
Absolutely, Trent. I mean, it's significant. And as I said earlier, a very small percentage of people actually use these depreciation reports. But I can highly recommend them. Property investors can use depreciation as a non-cash expense and as a tax deduction. In other words, a depreciation report can save you money on your investment property.
As we said before, negative gearing is a situation we want to be in as a result of losing money yearly.
Yep.
But just to clear it up, by claiming depreciation through a depreciation report, we could be just assisting with that tax benefit whilst not actually losing money every year.
Absolutely. It is in a negative gearing exercise, it obviously then becomes a loss to the investor, which they then claim in return at the end of their financial year when they do their tax. So an example, we have a property that earns probably $40,000. We have an example here with us. Depreciation prepared by CBRE reflects, without going through the ins and outs, about $24,000 depreciation per year. And when you sort of work that through the whole system, the saving to the investor between getting a depreciation schedule, generally between about $500 and $600 to get a decent report, is generally around about $10,000 per year on the example I could certainly run through. But it is certainly worthwhile all residential investors looking into depreciation schedules as an option and discussing it with their accountants.
So let's flesh out that cost benefit. As you just mentioned, $500-$600, that's for a full report. You know, for example, your guys, your quantity surveyors would be going out there listing a very detailed report for that $500-$600. You could get it cheaper, couldn't you?
Well, like anything, you can get anything cheaper, but when you talk about the saving of up to $10,000 or more per year, you want to make sure that initial investment, which also is tax deductible, is a worthwhile report and saving you a maximum in terms of your benefits to your personal investment.
That makes sense. So let's say it's a $500-$600 report. We can claim that as a taxable expense. So straight away, let's say if your effective tax rate is 30%, you're obviously getting around that $200 back as a tax benefit off of that price. And then let's say the depreciation report provides for a $10,000 deduction every year. That could be $3,500 in cash back to you every year. Obviously, it declines over time, but that benefit should really be paying itself off straight away.
Well, the obvious benefit is a new product, a new house built, a new apartment, maximum benefits at that point in time, and they do diminish over time, but they do extrapolate out to be significant savings to the property investor.
So, Mike, let's make it really clear. Let's put an example out. Use some round numbers. And put it out on the table.
Okay. Property worth purchase price of $800,000. Is generally obviously a higher end property, but we'll use that as an example.
We're buying a brand new house in Wembley.
Yep. Okay. So as an investment property.
As an investment property.
Yes. I'm not sure if too many investors of the owner-occupier market, but this example, let's just say our income's $40,000 per annum. Our gross rent on that, are we getting back $40,000? The depreciation schedule we prepared reflected about $24,000 per annum in the initial years as a deduction for the investor. Taxable income then is $40,000 less the $24,000. All of a sudden, it's $16,000 that you're earning net in that particular investment.
On the book, even though that $24K wasn't actually coming out of your bank account.
Correct. There's no cost to you in that respect. It's basically the inspection's done by a residential property expert, be a valuer or a quantity surveyor, who then prepares the report for you as the investor. And as you extrapolate that through, obviously there's some tax brackets, so we can't really run through that example because
it's different for everyone in what bracket they're in.
Correct.
Whether if this is if you're a retiree, this is your only income, you may be paying no tax anyway. However, if you're on $250,000 a year, this could be a massive benefit. Could be $10,000, $11,000 in cash back to you.
Regardless, it's an investment, it's a saving, it's a tax benefit, and it's one that we as West Australians need to really sort of look into a little harder.
Mike, thanks a lot for your time. Hopefully we can have you in again soon.
Thanks, Trent.
Okay, so for today's Suburb Spotlight, we are on location in Karratha. I'm very, very proud to say that I'm sitting in the boardroom of Rob Sleator-owned Pilbara Real Estate. I'm here talking to, obviously, Mr. Karratha. Rob Sleator, thanks very much for giving us your time and showing me around the town throughout the day.
That's quite all right, Trent. Thanks for making the effort to come up. And flights aren't cheap to get up here, but you missed a cyclone by 7 days, so you were lucky.
I consider myself very lucky. When we drive around today and you see every second verge filled with palm trees and other types of foliage where people have been working their butt off for the last week just to get things back on the ground. And you can understand the lifestyle people sometimes up for when they're living up in the iron ore region.
We dodged a bullet. Headland copped it a lot more than we did because they were on the eastern side of the eye of the cyclone. So they had a lot more damage, a lot more flooding. And what that means in real estate is insurance and property maintenance.
Yeah, we've spoken about insurance today, and obviously being up in the region, insurance will be higher, but at the same time that's offset by some pretty amazing yields that are still happening in places like Karratha, given the price difference we've had. So maybe we can start off like we always do, start from the past and work forward. And maybe we'll crack on with getting a history from you, a little bit of a history lesson on your town, Karratha, and how it started and where we are today.
Karratha's, the whole base of it was iron ore, coming out from Hammersley Ranges and getting trained up to Dampier and loaded onto ships. And that was in the 60s. Dampier just had their 50-year anniversary, I think 2 years ago. So that sort of gives you a nature of a very young town. But Karratha was formed a few years after Dampier as a service centre because Dampier is landlocked. Karratha was a service centre for expanding shopping centres and to service everything up here.
It's hard to imagine a place in Australia being landlocked, isn't it? But when you walk outside town and you look over across the Dampier, you can see this. It's quite a mountainous range that locks you into that port.
Yeah, look, I mean, a lot of people, I take them out there and they literally tell me that it just looks like people have dumped rocks on a hill. And if you've ever seen the Northwest Shelf or around the Burrup, I mean, it's just amazing to look at. It's rugged beauty. But you look at it, it's like nothing you've seen before.
Yeah, and obviously Karratha, much more flat land, a little lower lying. So there are regions that I guess we should speak about that are more prone to flood zones and regions that are less. And that would affect property prices here, wouldn't it? Things that we don't have to really consider in Perth.
Definitely. I mean, certainly the lower Lower levels, if you do a development on a lower level, it's going to cost you another 80 grand because you need to put the fill in, and also when there's cyclones, the higher levels of insurance as well.
Okay, so let's fast forward to today. Most of us, I guess, in Perth would know what happened in Karratha. We spoke about it with your counterpart, I guess, in being Rick Hockey last week for Headland. The story is pretty similar, isn't it, in the last 10 years? These days, how's life in Karratha? What sort of people, compared to 10 years ago maybe, are buying property in Karratha?
The majority of buyers at the moment are owner-occupiers with families and young kids. Because people come up here with a 1 or 2 year plan, meet someone, maybe have kids, and the demographics are changing. And, it's more about the families, and there's good schools. Like up here, you've got the Bainton pump track. It was the second only pump track in Australia. You don't have to pedal, you just pump it around. So Landcorp have dumped quite a bit of dollars into the region to make it livable. And, I've got a toddler, and the amount of mothers groups, and being a young family up here it's just the quality of life's good. 10 years ago, guess what? It was all investors. Everyone was chasing a 10 to 12% return. 78% of the Karratha rate roll in 2011 was investors. And you can think about it. Christmas comes, everyone gets the hell out of town. There's no Christmas lights, no pageants. Whereas now that with the markets and people are buying the houses, going to the nursery, buying plants, doing up the house, and this is it. It's a normal town. It's taken 50 years to get there.
Well, we were just saying, we were having lunch at the Pilbara Bakery, and you were just saying, look, this is the first time we got this bakery, and it came in a year ago. The butcher's just come in, and I was flabbergasted to hear that these fairly remedial services, I guess, services that everyone should expect in a small town, are only really just started to be invested in. And you made a really good point, and you said, Trent, if people can come up here and make twice the money as a technician or a storeman or something else for one of the mining or oil and gas companies, well, they take that risk and invest in a town that really is quite transient. But things are starting to change, isn't it? People are investing in small business and therefore investing in the town.
The town and everything about it is getting more in depth. It's more dimension. It's not just a worker town here and a bit of FIFO. You either work for Rio Tinto or Woodside or Yarra. There's a lot more to it now. It's getting a lot deeper, and there's a lot of exciting things on the horizon. So the fertiliser stuff, methanol, another iron ore mine, Bala. Woodside want to do hydrogen. The stuff is mind-boggling, and at the moment it's the 6th largest economy in Australia. Kick off a few of those major projects that are only talked about now. It's incredible.
Yeah, I think the interesting point to talk about in terms of dynamics, you really focused on there, is that the family vibe is coming back to town. So as a percentage basis, 10 years ago, the investor percentage of people, you said it was in the 70s. Now, what is it now?
Difficult to say what it is now, but every sale I do, and for the last sort of 3 years, you'd have 5 investors for every 100 sales.
Yeah, well, there you go. And that's a reality. And I think a big reason for that, and you've explained this as well, is access to cash and liquidity, especially for an investment loan. A lot of the banks, they're not allowing you to use rent as part of your equation, are they?
Look, that's it. Not only that, a lot of people are over-investing because there's always maintenance, there's always something going wrong. And up here, it's a harsher living. An aircon might last 4 years, and there's a lot more money that needs to be put back into a house. So, a lot of people have just had enough, cut and run.
Yep.
And new investors are getting in.
Well, obviously, people over the last 10 years have been burnt a lot from that massive drop that we saw from the boom, and that's the reality. People have lived through that, and what we're seeing now, it seems to be a changing of the guard. I always say the smart money moves first, and that smart money comes from the people with the first level of information, and those people are the locals, the ones who are here going, look, that house was $1 million 5-6 years ago. We can buy this massive 4x2 with all the things we need. It's a 6-year-old house for $500,000. What a bargain. And when you've got people like Brendan Ptolemy, who was on the podcast a few weeks ago, talking about places like Karratha and Headland, and saying specifically that Karratha bottomed out a year and a half ago and has had a 10% rise since then. Clearly people are starting to get a little bit more confidence. And you were saying that to me today as well, is that we hit that bottom, you call it a bottom, around that end of 2017 mark. So you saw it on the ground too.
Absolutely. You know when the market improves when you start getting multiple offers, and that is a clear sign. I've seen it twice in my real estate career in 16 years. As soon as you get multiple offers, you're below market, and that's when the buyers start realising that, and then they put in prices above asking. It's compelling.
I always go back to demand versus supply, and we spoke about it at the market update last night. Essentially, there is no more supply coming into Karratha, and that is because we are under replacement value. Unlike a property that you could build in Perth for maybe $250,000, it costs $500,000 to build that same house up here, just because of the location and the issues to build a house. And when properties are selling for $350,000, $400,000, in those sort of ranges, there's no incentive to build, and therefore there's no incentive to increase supply, is there?
Not yet.
That is I guess a boon for the investor though, looking to get in, understanding that until we get to replacement value, we are in an undervalued market where the price of those properties should continue to get closer to that equilibrium.
Look, the build costs have come down a little bit, but you got to think about it. Karratha and the Pilbara's got the highest building code in the country, a lot more than Queensland, more than Darwin.
Well, obviously for what happened last week.
Nothing happened last week. We got off lightly. That's the thing. Look at Cyclone Vance and things like that really wiped people out. But, we're 2 days freight to get up here. Look, everything's more expensive.
Yeah.
So, look, the bottom line that I see, an average house in Perth's, $500,000. Up here at the moment, it's about $380,000.
Yeah.
But
it's moved, hasn't it?
That's my calculations of it, but
yep.
Realistically, an average house up here should be more than average in Perth.
Yep.
One, you're getting paid more up here. Secondly, the building costs are more. Geographically further, it makes sense.
Well, and there's no more supply coming on, so that demand level should always be outstripping supply. Let's move on to, you just started talking about it then, was an easy segue into price points. Can we go through what it would cost to buy an apartment in Karratha at the 1x1, 2x1 level, and then can we step through to a 3x1 on some land, a 4x2, and then how expensive is it actually getting in Karratha right now?
A 1-bedroom apartment in Pelago, which is a Finbar product.
We can look at it across the road?
Absolutely, and I've sold heaps of them on Adelaide Terrace years ago, and I've even bought some. I had one on Times2, 148 Adelaide Terrace, so I am familiar with the product. It's an average product, and that's it. But you pick one up here for $280,000 to $300,000. During the boom, we sold them from $550,000 to $640,000.
How about those 2x1s we were looking at today? That one was going for $199,000.
Yeah, I mean, it's similar size product, 54 square metres, $195,000.
A little bit further out from town, but in the suburbs.
Rents out at $450,000. It's not too bad.
Yep.
If you're in Perth and you're getting $450,000 for a 1-bedroom apartment in the city, I mean, you'd be paying anywhere from $350,000 to $400,000.
3x1s, 4x2s around here. What are we paying?
A 3x1, which I've got an offer on right now at $285,000, and hopefully we close it at $290,000. Look, the top end at the moment is in the mid 600s, and that'll be a big 4-2 plus theatre, separate living, garage, pool. You have to have a pool up here.
Big shed. Seems like a shed is a mandatory feature in a house that's going to sell.
A big shed is ideal, but what you've got to understand, the fundamentals of Australian property block size is getting smaller and smaller and smaller. In the 60s, they were all bigger than 1,000 square metres. The new estate, Bankton West, I think the average there is about 580, and this is in a regional town. 580 or 600 square metres in a regional town. You'd think you could at least go 800.
Yeah. They're about 370 in Perth these days, so you might still have a bit of space for those new sheds. But we looked at a few places today, didn't we? And they had sheds. and the guys go straight out there to have a look how big they can fit their boat or motorbikes or cars or whatnot. And it's a reality. It might be a stereotype, but the stereotype reflects reality up here, is that when you're up here, you want to make sure you're enjoying your life.
Yes, I mean, the small boat ownership is massive. You know, people have got campers. Look, I never thought I would have bought a camper trailer, and the last show that we had up here, I ended up buying one. It was the most expensive show in my whole life.
Well, I think you told me this morning that Karratha's got the highest boat per person ratio in the country.
Yes, I mean, look, some people have got 2 boats. And that's when you got a boat for the creek to get mud crabs and barramundi. I still haven't caught a barra in 8 years.
Okay.
And then a bigger boat to go out and catch your Spanish mackerel, but Red Empress is number 1. Wow.
We're going to do a massive segue now into a topic that we always talk about. However, I think will be a little bit off topic today, and that is development opportunities. Are there many opportunities in Karratha, or given the massive cost of building compared to what the prices are right now, is it pretty dead right now in the development space?
Yeah, the last development was 2014, and that developer unfortunately went under. So look, there's always opportunities. It just means you really need to land bank it until prices come up.
Well, I've heard 2 stories in the last 24 hours of people buying, whether it's off an owner or off a mining company, massive numbers of properties in the same purchase. Just a lad we were talking to last night, 32 apartments for $1.2 million. There seems to be opportunities here where if you might not be actually making and doing a development, you could be buying a development at wholesale and then splitting it up, reverse engineering it. Do many of those options come up where you can buy multiple properties on the same title or in the same purchase?
You know, the last couple of years there's been a few good opportunities, but, you know, it's rare. It's rare to see that. Like what I took you today, 16 units on one title. Guys had it more than 12 months. It's already gone up more than 10%.
But he's selling these off individually, right?
That's it.
$200,000 a pop, that's 3.2 mil. He bought it for 1.7 mil just over a year ago. Pretty good deal for a place where everyone thinks it's too risky to pop your head in.
It is, and that's the thing, everyone buys together, everyone sells together. So if you buy when everyone's been fearful, Warren Buffett, and this guy stood out and he did it. But he understands the region. That's the difference.
That's the key. You've got to come up here, don't you? You really have to understand the dynamics, the difference. At one point we were driving down the road today and you said that house, absolutely fantastic, $900,000 there. Really good area here in Bainton. I don't think we turned more than 2 corners, and then you were showing me some places where knock down. You really can't just go and look at a map on Google Maps and pick a property. No,
and look, saying that, there was investors that bought in places like Roebourne and that's a challenge. That's all I can say. It's a challenge, and even investors that bought and they still haven't seen their property. One investor paid $800,000 for a property. Be lucky to get $350,000 for it now, and they're angry. You know,
they're not doing their due diligence though. They're getting on the horse. It's the fear of missing out, and they were the last to jump in and the first to feel the pain.
Well, I think they paid $800,000 for a property, and it's not giving them the return they want. And I understand they've been upset, but they really need to get up here, have a look at what they look. As an investor, you need to be responsible. You need to come up and look at your product.
Final question for this segment, Rob, and I ask the number one agent of their suburb every week this question. We've broached it just before. What's the median house price of your area? And if you had that money in your pocket to spend today, you had to buy something today, what would you buy?
I'd buy this 3x2 that I'm selling at the moment that will close at 3,225, and I'd spend some money on it and turn it into a 4x2 and do it up, because I just sold one similar with one less bedroom for $445.
Is that easy enough to do? Get a little bit of renovation done, and I guess you're focusing on the yield of the bedrooms?
Yield on the bedroom, but also adding value adding. I think, if you know what you're doing, you can definitely do it. But, you don't want to rush it, and you want to do your due diligence.
Rob, thanks a lot for letting me into your world in Karratha, for hosting me and looking after a property enthusiast in his first time in Karratha. We've got a special way to finish off today's episode, and that is with a young lad who's written into the show. His name's Chris. So hello, Chris. Thanks for writing in. Chris has just bought his first house. So I thought, for someone with your experience in both Perth and Karratha, you might get some good information out of the two of us putting our heads together. Chris has said, Trent and Co, thanks a lot, love the show, sharing it with all my mates. Thank you, keep doing that. He's 23 years old and he's just bought his first house in Lansdale. Proud of the fact that he bought it for $480 when the previous owner paid $542. He doesn't want to live there forever. He's got a plan that he wants to get closer down the train line towards the Stirling area in the next 5 to 7 years. But obviously, saving for that next deposit and getting up that property ladder is something that is not the easiest thing to plan. What is our advice or recommendations on how he should get to that next level in his property journey when he already has this first existing property?
Well done for saving, holding out and getting into property. Well done, mate. That's awesome. It's good that your attitude's positive and you're on the right track. Look, it's different sort of to make judgment on what he's making, what his budget is. Any extra savings good, but also adding value is going to spend some money as well. So it's a bit of an oxymoron to save money, but you're going to spend some money on a differentiating.
Well, that's investing,
product.
isn't it? At the end of the day, you have to invest money to make money.
Yeah.
So whether it's on your current house or on its managed funds,
Yep.
Or even family guarantees. He's a young lad. He's obviously shown the ability to save up. Maybe he's proven to his parents, and hopefully his parents in a position where maybe they can assist with helping him get that security for a first investment outside of the Lansdale home he's bought.
Yeah, look, there's plenty of opportunities, and look, I had 2 real good runs in Perth, one in Willetton, one in South Perth. And if you can get the cheapest property in a decent location, you're doing well. And it's always that location. I bought my last house in Perth, which I don't have now, Douglas Ave, South Perth. Got a good deal. And that sort of product it's always in demand.
So when you eventually have that cash, or even if you're not sure if you have enough yet, probably go and see a broker just to figure out how close you are to that next deal. You might be underestimating how close you are to getting that next property, and always make sure that you're getting that Lansdale property revalued. It's a game with the banks in terms of what the book value is. So if you can get a good valuation on the books, soak up a bit of that equity, put a bit of cash into it. Maybe even if you went on a 10% deposit, if you could see it as a business case to pay that LMI, the quicker you can get back onto that property ladder in a good area where there might be some land, as Rob was speaking of before. Land always appreciates, houses depreciate. The quicker you can get onto that side, that would probably be of assistance.
Look, the only other thing I can add, as you go closer to the city, you're going to get a smaller block. And look, you may end up with a 2x1 villa in Yokine. That could be the next step for you. And look, everything in life, and especially in real estate, is a trade-off, unless you got stacks and stacks of cash. So if you're coming from Lansdale with, $480, somewhere in that ballpark, get into Yokine at that level, or everything will be a bit smaller and a bit older, and then you value add from there.
Rob, thanks very much for participating, for helping out with Chris's aspirations, and hopefully we can have a chat, whether it's back in the studio in Perth or up here again for an update on how Karratha is going in the near future.
That's all right. Thanks for coming, Trent.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!